Okay, so the world of money is changing, and it's changing fast. The Bank of England has just dropped its new game plan for the future, a rule book for how digital currencies, specifically stablecoins, can finally step out of the shadows and into our everyday lives. Safely. So let's get into it and see what this actually means.
Right, picture this. You're paying for your coffee with a digital pound. It's instant, it's cheap, it's seamless, it just works. Now imagine that same digital pound being worthless by the time you wake up tomorrow. That's the nightmare scenario, and it's the exact problem the Bank of England is trying to solve. How do we get all the cool innovation of digital cash without risking a total financial meltdown?
So here's how we're going to break it all down. First, we'll look at why digital cash is becoming such a big deal. Then we'll talk about the tipping point, when a stablecoin becomes systemic or, too big to fail. After that, we'll dig into the brand new rules for how these things have to be backed. We'll even look at some proposed limits on your digital wallet, and then finally, we'll tie it all together to see what the future of money might look like.
All right, first up, the rise of digital cash. The Bank of England is being really clear here. This is not about stopping new ideas in their tracks. Nope, this is about building a rock-solid foundation so that all this cool financial innovation can actually happen without, bringing the whole house down.
And really, the governor of the Bank of England, Andrew Bailey, just hits the nail on the head with this quote. When you boil it all down, this whole plan is about one word: trust. The goal is to make sure that a new digital pound in your phone feels just as real and just as reliable as a physical pound in your pocket.
So that brings us to the big question, the one that really kicks off all these regulations. When does a stablecoin stop being just some niche crypto thing and start being a fundamental part of our financial system?
So what in the world is a systemic stablecoin? Well, you can just think of it as a digital currency that's become too big to fail. It's gotten so popular for everyday payments that if something went wrong with it, its collapse could literally send shockwaves through the entire UK economy. It's a big deal.
Now, to make this real, the bank actually cooked up a few fake examples. First, let's look at Coin Group. Imagine a huge social media company launching its own coin. Because it's already built into a platform with billions of users, it could get massive almost overnight. The bank's verdict? This thing is systemic from the moment it launches, day one.
Okay, next up is Coin International. Now, this is an existing stablecoin. Maybe it's big in the gaming world or for crypto trading. Right now, it's not a big concern. But if it suddenly announces partnerships with major UK supermarkets so you can use it to buy your groceries, well, that changes everything. The bank sees that as a clear path to becoming systemic, even if it's not quite there yet.
And finally, just to be super clear on what doesn't count, we have Coin Exchange. This is just a crypto trading platform where people use stablecoins to hop between Bitcoin and Ethereum. Since the general public isn't using it to pay their bills, its failure wouldn't really affect the wider economy. And that's the key difference. It's all about everyday payments, not just trading.
Okay, so if a stablecoin gets that big and becomes systemic, how do you make sure it's actually safe? Well, that leads us right to the core of this whole proposal, the new rules for backing.
The main idea here is actually pretty simple. Every single digital pound out there has to be backed, one for one, by real ultra-safe assets. It's basically a promise that for every stablecoin you own, the company behind it has an actual pound's worth of value, like cash, locked away to guarantee it's always worth a pound.
And this is where it gets really interesting. The bank's first idea back in 2023 was super strict. They said issuers had to back 100% of their coins with cash just sitting at the Bank of England, earning zero interest. The industry, well, they said that would basically kill their business. So in a pretty big move, the bank actually listened, and this new plan is a lot more flexible.
The new plan finds a middle ground. At least 40% of the backing has to be pure cash held at the central bank. Think of that as the ultimate emergency fund for a crisis. The other 60% can be invested in short-term UK government debt, which is still incredibly safe, but it lets the company earn a little bit of a return. It makes the whole thing a viable business. And to make sure they're not just crushing new startups, the bank also created this step-up plan. A brand new stablecoin could start out holding most of its backing in those government bonds that earn a return. Then, as it gets bigger and more important, it has to gradually shift more of its holdings into that pure cash reserve. It's kind of like giving a new business training wheels before they have to compete in the Tour de France.
All right, let's talk about the part of this that could hit closest to home for all of us: potential limits on your digital wallet.
So the bank is floating the idea of a temporary holding limit of £20,000 for individuals. But here's the crucial detail. This limit is per stablecoin. So, in theory, you could hold 20 grand in one company's digital pound and another 20 grand in a different one.
And here's the full picture. It's £20,000 for you and me, and a much bigger £10 million for businesses. But what's really smart is this exemption clause. A huge company like a supermarket that might take in millions in digital payments every day could apply for a higher limit. It's practical.
So why even have these limits in the first place? Well, the bank sees them as a temporary circuit breaker. They're worried that if everyone pulled their money out of traditional bank accounts and into stablecoins all at once, it could seriously mess with the banking system. So these limits are just there to manage the transition smoothly, and the plan is to eventually get rid of them altogether.
So, after all that, what's the big idea? What's the end game here? Let's zoom out for this last part and look at the grand vision for the future of money.
The ultimate goal is something called interoperability. It sounds complicated, but just think of it like universal plumbing. The vision is a future where a new stablecoin, a digital deposit from your bank, and regular old money can all connect and be swapped for each other, seamlessly, with a pound always being worth a pound. It just works.
And look, this isn't some rush job. The bank has been on this path for years. They put out a discussion paper back in 2023. We're at the consultation stage right now in 2025, and we probably won't see the final rules until 2026. It just goes to show how carefully they're trying to get this right.
Which leaves us with the big final question. The Bank of England is walking a very fine line here. Are these rules going to build a safe bridge to the future of digital money, or are they accidentally building a regulatory wall that just stops the next wave of innovation cold? Getting that balance right is everything, and it's going to define what our money looks like for years to come.